The US markets are currently closed. Nuburu, the core of Nuburu's value proposition, isn't just that it makes lasers, it's that it makes blue lasers. And the specific wavelength of blue light is uniquely effective at being absorbed by copper, a metal that is foundational to the entire green energy and electric vehicle transition. While standard infrared lasers see much of their energy reflected away by copper, leading to slower, spottier welds, Nuburu's blue light is absorbed almost perfectly. This creates a faster, stronger, and defect-free bond, which is precisely what manufacturers of EV batteries and power electronics are desperately seeking. So while the market sees a failing company, the underlying technology addresses a critical manufacturing bottleneck for some of the world's fastest-growing industries. The common belief, and it's not without merit, is that Nuburu is in a death spiral. After its debut via a SPAC merger, the stock has been decimated. It has received non-compliance notices from the NYSE for its low share price, a clear signal of distress. Retail investors, many of whom might have jumped in using accessible platforms like the Robinhood app or SoFi Invest, have been crushed. The narrative is one of failure, of a promising technology that couldn't translate into a sustainable business. But let's challenge that perspective for a moment. The difficult truth is that commercializing new hardware technology is brutally difficult and capital-intensive. The company's current struggles aren't necessarily an indictment of the technology itself, but rather a reflection of this harsh reality. The deeper question is whether the market has priced in the risk so excessively that it's now overlooking the potential reward if the company can secure its footing. The disconnect between the technological imperative for blue lasers in modern manufacturing and the company's financial state is where the real story is. This isn't just another struggling small cap, it's a race against time between a potentially indispensable technology and a dwindling balance sheet. Looking at the recent stock movement, the chart tells a story of relentless selling pressure. Trading volumes are often thin, punctuated by sharp spikes on news of delisting warnings or quarterly earnings. This pattern suggests a lack of sustained institutional interest, leaving the stock to be tossed around by retail traders and short sellers. For anyone using more sophisticated platforms like interactive brokers to analyze trading data, the order book would likely show a significant imbalance, with sellers consistently overwhelming buyers. This isn't the kind of steady accumulation you'd see in a healthy company. Instead, it's the chaotic, news-driven volatility characteristic of a distressed asset. When we look at institutional ownership, it's sparse. Major funds and wealth management firms, like those at Fidelity, typically have mandates that prevent them from holding stocks priced this low, or with such small market capitalizations. This creates a vacuum of stable long-term ownership, exacerbating the stock's volatility. The reaction to their latest earnings report was telling. While the company may have highlighted small contract wins or technological milestones, the market's focus remained squarely on the cash burn rate and the shrinking runway. It's a classic case where operational progress is completely overshadowed by financial precarity. Even positive developments in the broader EV sector, which should theoretically be a tailwind, have provided little lift. News that drives Tesla stock higher doesn't trickle down to a potential supplier like Nuburu when that supplier's very survival is in question. So what does Nuburu actually do? The company designs and manufactures high-power blue industrial lasers. Think of them as creating a new class of tools for the 21st century factory floor. Their primary market is materials processing, specifically for welding and 3D printing. The key advantage, as mentioned, lies in the physics of light absorption. Metals like copper and aluminum, which are central to batteries, electric motors, and electronics, are highly reflective to the infrared lasers that have dominated the industry for decades. Nuburu's technology solves this. Their business model involves selling these laser systems directly to manufacturers in the automotive, aerospace, defense, and electronics sectors. They went public in 2023 through a merger with a special purpose acquisition company, or SPAC. This route to the public markets, popular for a time, often burdened companies with high expectations and insufficient capital, and Nuburu's trajectory has been a textbook example of the potential pitfalls. The initial excitement about its technology, which is genuinely impressive, was not enough to shield it from the operational challenges of scaling production, building a sales pipeline, and managing public company expenses, all within a tough macroeconomic environment. The company's past performance has been a painful lesson for early investors. The stock is down over 99% from its initial highs, a brutal reminder of the risks associated with speculative technology investments made without a clear path to profitability. For those looking for investment help or considering self-investing, Nuburu's story is a powerful case study in the difference between a great product and a great investment. Looking forward, the future of Nuburu is a study in contrasts, a binary outcome with very little middle ground. The bull case scenario rests on a few key catalysts. First and foremost is a significant, company-altering contract with a major automotive OEM or a battery manufacturing giant. An announcement that Nuburu's blue lasers will be integrated into the production line for a major EV model would be the ultimate validation. This would not only provide a substantial revenue stream, but also signal to the rest of the industry that the technology is ready for prime time. Second, securing a strategic investment or partnership could provide the capital necessary to stabilize the balance sheet and fund operations through to profitability. Imagine a larger industrial tech player, or even a company like Apple stock, always looking for manufacturing innovations, taking a stake. Third, successfully resolving its NYSE compliance issues would remove a major psychological overhang from the stock. All of these possibilities hinge on management's ability to execute under immense pressure. Comment below on what you believe is the single most important factor for Nuburu's potential turnaround: a breakthrough contract, new funding, or a change in management strategy. On the other hand, the risks are stark and immediate. The most pressing danger is liquidity. The company is burning through cash, and if it cannot secure new funding, it faces insolvency. This is not a distant threat, it's a near-term reality reflected in its financial statements. Any new funding, likely to come in the form of a secondary share offering, would heavily dilute existing shareholders, putting further pressure on the stock price even if it secures the company's survival. Competition is another significant risk. While Nuburu has a head start in high-power blue lasers, larger, better capitalized competitors in the industrial laser space are not standing still. They are developing their own solutions, and Nuburu's window of technological advantage may not stay open forever. Finally, there's execution risk. Can a small company effectively scale its manufacturing to meet the demands of a global industry? Can its sales team close the multi-million-dollar deals necessary to move the needle? The expectation from the technology is that it can become an industry standard. The reality is that the path from a lab to a factory floor is littered with operational and financial hurdles that have broken many promising companies. Investors using online investment sites or managing their own individual brokerage account must weigh this high probability of failure against the asymmetric upside if they succeed. In summary, the story of Nuburu is a classic battle between a compelling technological reality and a harsh financial expectation. The market's current verdict? It expects failure. The stock price, the delisting notices, and the lack of institutional sponsorship all point to a company on the brink. However, the reality of its underlying technology presents a powerful counter-narrative. The industrial world needs a better way to work with copper, and blue lasers are arguably the most elegant solution. Nuburu has that solution. The entire investment thesis boils down to one question: can it survive long enough to see its technology adopted? The disconnect between the 14-cent stock price and the multi-billion-dollar problem it solves is massive. For now, the market's expectation of financial collapse is winning, but the quiet reality of physics and manufacturing needs means that this story may not be over just yet. Disclaimer: this video is made only